Welcome to Get Rich Education. I'm your host, Keith Weinhold. In the real world, compound interest does not build wealth. Leverage does, and leverage comes from loans. What exactly does it take for you to qualify for an income property loan today on Get Rich Education?
Learn the easiest way to create wealth and passive income with real estate. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those investment properties. Norada Real Estate saves you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more at PassiveRealEstateInvesting.com and download your free copy of the ultimate guide to passive real estate investing. There's no obligation and nothing to buy. Simply visit PassiveRealEstateInvesting.com.
For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Caeli Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Hey, you're inside GRE. From Jamaica, Queens, New York to Kingston, Jamaica, and across 188 nations worldwide, I'm Keith Weinhold. This is Get Rich Education, but we're talking about exactly what it takes for you to qualify for an income property loan today. Mortgage loan qualification is such an important part of investing, and the good news is that mortgage interest rates just recently fell to their lowest level in a year. Let's consider that in the 5 ways that real estate pays you, those 5 different profit centers that you have, historically, number 1 is leverage appreciation. You get more return there than you do from cash flow or loan amortization or tax benefits or the inflation hedging. That's why once or twice a year, we talk with a mortgage loan pro that specializes in investment property loans, those non-owner occupied loans. So yes, in the short term, mortgage interest rates have indeed hit that lowest mark in a year. As for the long term, over the decades, you'll recall that just last month, we hosted one of the most often quoted financial and business commentators of the century, the illustrious Jim Rogers, and here's what he had to tell you about the future direction of interest rates.
You ask me, we're now headed up again, and interest rates are going to go much, much, much higher over the next few decades.
Then I asked a natural follow-up question on how an investor would best be served by acting upon that information.
If you can borrow a lot of money for a long period of time at low interest rates, rush out and do it right now. Because, as I just said, interest rates are going to be going higher for a long period of time, and you will have a huge advantage if you can lock in rates now.
So there you go. And to qualify that, if you're going to borrow a lot of money, even at a low fixed interest rate for the long term, you need to invest those borrowed dollars such that the investment yield covers your debt service. Well, enter cash flowing real estate. Because mortgage lending is a dynamic field where your qualification criteria to get a loan often changes, let's get an update from today's guest. Today's guest is the president and CEO of Ridge Lending Group, and she has spent the last almost 21 years as a nationwide lender, loan officer, and real estate investor herself. So she really understands what you need. Her firm specializes in income property loans. So we're not talking about primary residence loans today, but income property loans. And they've worked with tens of thousands of investors and homeowners just like you all over the U.S. and outside the U.S. And if you've been listening here for any amount of time, you already know that she has helped more people realize their dreams of financial freedom through real estate than any other mortgage lender in all of the United States. It's a real honor to welcome back onto Get Rich Education, donating her time to you once again. Here is Ridge Lending Group President and CEO, Caeli Ridge.
Yay, Keith Weinhold. So great to be here again. Thank you for having me, sir.
I'm so glad you're back. It's good to speak with you annually or more often because mortgage lending is one of the more dynamic fields. So just as a reminder to the listener, if you're listening to this in the year 2024 or later, or it won't even take that long, and things do change. But Caeli, just talking about today, what are today's mortgage rates for a non-owner occupied 1 to 4 unit property?
Yes, I took some time this morning and checked current pricing. So let's set the stage real quick because there's a variety of variables that often will play a role in what the actual interest rate are. So I'm going to give the characteristics and then provide those interest rates as they are today, keeping in mind that dynamic comment that you made, subject to change. Secondary markets can be volatile, so keep that in mind when your listeners are hearing this. Let's assume the following characteristics. An investment property purchase, single family residence. Let's use $135,000 purchase price, and we'll start with a down payment of 20%. I'll also provide 25% interest rates, and I want to give a comparison on that once we get through the interest rates. And then lastly, let's assume a 740 or better credit score.
That is the best credit score to give you the lowest rate, 740 FICO.
And above, yep. And just to clarify, I often get the question, well, I have 800 credit score, will that help my interest rate? As a division or as difference between 740 and 800, it plays no role. That's the same exact bucket. So anything over 740 is going to be the same.
My thought about an 800 credit score is not necessarily, but sometimes that might just be a sign that you're not borrowing enough.
Maybe. Might be. It's more, most people want the 800 credit score for psychological purposes, but it certainly isn't necessary for the qualification of investment financing.
Right.
So based on that criteria, today's interest rates for 20% down are posting at 5.5% on a 30-year fixed mortgage. At 25% down, the interest rates posting today, 5.125%. Now, the comparison that I want to give there, I recognize that the interest rate is better on the 75% loan to value. And a lot of people have, speaking of psychological needs, they hear that and they think that's going to be the better way to proceed. Now, I think you and I will probably agree that it's the leverage, right? The higher 80% loan to value that's going to give us the greater rate of return. I won't go too far down the math of that rabbit hole, but what I would like to share with your listeners is that the difference, the calculation that they should be looking at is the out-of-pocket difference between the two. 5% of $135,000 is $6,700. But the monthly payment difference between the two is about $60 a month. The math is simple. You would take the $6,700, divide it by the $60 a month savings, and that generates a number which equals the number of months. In this case, that's roughly 112 months, which equates to 9.3 years, I believe. Yeah, so you know where I'm going with this. If you think about it from that perspective, that $6,700 can be used in more meaningful ways from a leverage perspective to increase that ROI.
That breakdown was perfect, and those are the same sorts of numbers that I've run over the years. And yeah, especially when interest rates are this low, you also have the ability to borrow 80% rather than 75%. And additionally, since you can only get so many loans at the best terms, and there is that leverage difference, 5-to-1 with 20% down versus 4-to-1 with 25% down, there really are a lot of compelling reasons. It depends on your situation, but I think for taking that leverage and taking that 20% down. And as a reminder, income properties have higher interest rates than primary residences do, and that's basically due to the fact that there is a risk premium expected. So you, the listener, just put yourself in the shoes of the bank. If you were going to make a loan to someone that lives in Los Angeles and they want a loan on their primary residence in Los Angeles, they're going to have one interest rate. But to you, say you live in Los Angeles as the investor, but you have an income property in Tampa, well, if you run into financial difficulty, it's a lot easier for you to walk away from your income property in Tampa because those are not the four walls in the roof that you're domiciled in. So we typically see 0.5% or more, Caeli, for a non-owner occupied interest rate, just in this example, in Tampa than we would in one's primary residence in LA.
Yeah, perfectly articulated. I'm glad that you gave that example, Keith. Generally speaking, you're going to find that the interest rate difference from primary residence to non-owner occupied, assuming that the other characteristics are equal, apples to apples, half to a full percentage point is typically what you'll find the difference in the 30-year fixed rate to be.
Talk about some of the other qualifications that one needs to qualify for an income property loan today. We already touched on the credit score a little bit, but what are some of those other things, especially with DTI, that debt to income ratio that often hangs up investors from qualifying for more new property? I know that when I was a new investor, that was my hang up as well. The DTI, the debt to income ratio. Tell us about that.
Yeah, I would say of the three most heavily weighted criteria, I'll just state those really quick. We talked about credit, assets, and DTI. It is the DTI, or debt to income ratio, that can be the most elusive. And before I get into any of the formulas used from a conventional or otherwise underwriting perspective, I want to start by just commenting that not all lenders are created equal in the way they're going to calculate the individual's income versus their monthly liabilities. To simplify, let me just say, and we'll focus on conventional financing for a moment. Fannie Mae and Freddie Mac produce what is called the Seller's Guide. This is a 1,400-page document that very clearly, in ridiculous detail, tells us exactly what the criteria or the guidelines are qualifying for a mortgage, owner-occupied, non-owner-occupied, etc. Ridge Lending Group is going to follow the purest form of those guidelines, whereas I would say a large or a vast majority of the other bankers or lenders or brokers out there are going to apply what we call overlays. These are additional risk layers to the purest form of the guideline that they're going to impose on the individual borrower. This is especially true for non-owner occupied financing. Because we don't do that, I find that our clients that come to us that may have had difficulty in the past qualifying in the DTI space don't find that to be true with us. We know how to calculate income from that pure form. We know the tricks, if you will, what we get to add back in, depreciation, one-off expenses, things like that. So first and foremost, I want to be clear about we're not all created equal, right? So if you think your DTI might have been a problem because a lender A, B, or C said it was, make sure to not just take that at face value. We want to exhaust the possibility from our underwriting process before we move you on to a different product. Now, debt to income ratio is actually a very simple calculation. We're going to take the monthly income that's extracted from the documentation that the borrower has supplied us, and we're going to divide it by the monthly liabilities found almost exclusively on the individual's credit report. That exclusivity comment comes with three different elements. Those are going to be HOA dues, if you're a renter, and any taxes or insurance that are paid separate from a mortgage payment. Those are the only three exclusions to the monthly credit report minimum payments that we'll find there. Everything that goes into the DTI, except for those three, will be on that credit report. The reason I make a point to bring this up is that oftentimes the consumer assumes that the regular living expenses that they pay on a month-by-month, cell phone, utilities, gas, food, entertainment, that those elements are also included in DTI, and they are not. It will be reserved to the credit report. So the division of the income versus the monthly liabilities gives us a maximum threshold to qualify at 50%.
That's pretty generous and higher than I seem to remember being in previous years. Is that right?
It has gone up. Yeah, it was 45%. Case by case with compensating factors, we could get to as high as 50, but they removed the compensating factor, and now it's just a straight 50%.
Yeah, that's pretty generous. DTI, the ratio of one's debt in proportion to their income. Total debt divided by total income is all we're talking about here in the simplest terms. Now, how does one define total debt divided by total income? Well, say your total monthly debt is $2,000 and your total monthly income is $6,000. On the total monthly income, we're talking about gross monthly income from your employer. And for total debt, let's just say you have a total monthly debt of $2,000 divided by $6,000 of total gross income. So what goes into that $2,000? We call that total debt. Well, what is total debt? We're talking about things like the minimum payment on your auto loan, the minimum credit card payment that you have, and how much your rent is or how much your housing payment is. And your housing payment for your own primary residence, that's defined as PITI, principal, interest, taxes, and insurance. That's what goes into some of those $2,000 of total monthly debt in this example, divided by $6,000 of gross monthly income. Well, that would give you a DTI of 33%. And there's nothing wrong with 33% because you can go up to 50. But now I've run into this before when I was an up-and-coming investor years ago, where maybe my DTI was too high. But just sticking with this example, since we just calculated 2,000 divided by 6,000 for 33%, just say we needed to get that lower. One time I had a $500 car payment, just say in this same example, and I had a $5,000 balance on the car loan. Well, even though I had extra cash, I didn't want to pay down the car loan because my car loan was at 3%. So why would I want to retire that debt? Well, the answer in this case is I wanted to retire that $5,000 car loan, which had a $500 a month payment, because that way it could bring down my DTI with just paying $5K just to get rid of it. Now, I really didn't want to retire a low interest rate car loan, but if that allowed me to buy another income property, that's what I did. So in that case, then I retired that $500 car payment, and that made my total debt $1,500 a month, not $2,000 any longer. I still had the income of, just say, for example, $6,000 in this case, $1,500 divided by $6,000. Now I brought my DTI down to 25% from 33%. So that's an example of something that you can do to reduce your DTI. I know your DTI might be higher in that case. Most people's are. Just thought that those numbers made for a convenient example.
I love that you give the examples. I think it's so helpful to the listener, right? I mean, I don't know about you or anybody listening. I'm not necessarily an audio learner. I'm more of a visual, so I think the example definitely helps. A couple of things I just want to mention briefly, and this kind of adds to some of the strengths of who we are and what we do and the deep understanding of the guidelines. It just caught my attention. One of the workarounds in underwriting guidelines is that an installment loan equal to a car payment, for example, in your example, that $500, if there are less than 10 or less months left on that installment loan, we do not need to count it in the DTI calculation. So just as a little sidebar against that. Additionally, and I don't know if you want to go too far down this rabbit hole, Keith, but we have yet to talk about how the property itself and the rental income can help support the DTI. And in fact, if you don't mind, I'm just going to give the formula used in the acquisition year of the property, which means before it falls on the Schedule E. That's a conversation probably for another time. But the acquisition year, AKA from the date of acquisition and up until that year's tax return is filed to include that property, the formula for calculating rental income against the new mortgage payment is very simple.
Okay.
We will give the individual 75% of the gross rents minus that PITI, principal, interest, tax, and insurance. Now, my example that I always use for round number purposes, let's say that we have $1,000 a month of gross rents, and the PITI of our new mortgage payment for this property we're acquiring is $500 a month. In underwriting to include that property, I'm going to give the individual credit for 75% of our $1,000. So we've got $750. I'm going to subtract from that my $500 a month of PITI, leaving us with what? A $250 positive income, right?
Right.
Now, that's a positive number. So, of course, I get to add it into the income column when we recalculate the individual's DTI to include that property. So think about that for a second. Two things have happened. I've totally covered the new mortgage payment. It's gone, it's handled. And I've actually increased the individual's income, whereby I have driven down or reduced the DTI by that margin. That's pretty special. Depending on the property and the market, of course, I can tell your listeners that from the 08-09 crash, running that very formula, I have never seen it produce a negative number. But whether it's $1 positive or $250 to my example, it will be to the individual's advantage in that DTI space.
I am so glad that you explained that. You basically answered the question, how will new income property purchases affect my DTI going forward?
Correct. Now, the Schedule E is another conversation. It's quite definitely more complicated. In any case, the listeners should know that acquisition year formula will be to their advantage.
Yeah, that's some very good news. You're listening to Get Rich Education. We're talking with Caeli Ridge, President and CEO of Ridge Lending Group. More when we come back. I'm your host, Keith Weinhold. MC Lobsher is the host of the Cashflow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the #1 strategy of investors in his holistic wealth creation course at yourownbankingsystem.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
This is Richard Duncan, publisher of Macro Watch. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Caeli Ridge, the president and CEO of Ridge Lending Group. This is such an important discussion because debt basically makes and creates leverage for you, which amplifies your rate of return. You don't need a high rate of return if you're leveraged in order to get a high rate of return overall. So, Caeli, a question I so commonly get is, well, now what am I supposed to do if I'm single and I already exhaust my first 10 Fannie Freddie loans on 1 to 4 unit properties? Or if we're married, what do I do after I exhaust my first 20? Wouldn't I be done then? But you've actually got a great answer for this, and you really have a great specialty loan product. And I know the last time we talked, your specialty loan product, the terms were not as good, but they really weren't that disadvantageous compared to what we call the golden ticket, first 10 or first 20. Tell us about your specialty loan products and their terms.
And I'll tell you that as time has passed, Keith, we find that the margin for interest rate in particular, and I'll explain what I mean in a second, between conventional and specialty are narrowing as the months and years go on.
That's good news.
Yeah, very good news. Let's talk about specialty. So beyond the 10, right, the golden tickets as we call them, for investors that want to maintain or stay in the residential space and they want to continue to leverage fixed rate mortgages, our specialty product line has a variety of loan options, which the one for investors that have simply exhausted, right, they still have the debt to income ratio qualification, the credit, the assets, they would simply move into the non-QM, that stands for qualified mortgage, which is really equal to anything outside the Fannie and Freddie world. 30-year fixed, you're going to find the same leverage, basically the same underwriting criteria, a little bit different on the reserves. I can get into that if you want, but more or less the primary difference will be the interest rate, right? So again, still 30-year fixed, still 80% loan to value on a single family residence. The rate differential right now is going to be, let's say, 0.5 to 0.75 of a point, whereas a few years ago it was upwards of 2% higher. So like I said, that margin is really starting to narrow in terms of the competitiveness between secondary markets for non-QM and Fannie Freddie.
That's great news. And I seem to remember from last time, you still had not found a limit. So for a single person or a married couple, if they get up to 30 properties, 40 properties, you had not found a limit yet. Does that remain true?
That is still true today. Yep. I have not found an individual that has yet reached a point where we can no longer satisfy funding for them.
That is really good to hear. It almost seems like it's an urban myth out there, like you can't qualify for more property after your first 10 single and first 20 married, but I think you've really helped debunk that. For someone that's looking for more leverage, oftentimes they want to increase their velocity of money and take a potentially equity-heavy property that they had bought years ago and go ahead and reposition that equity into one or more, perhaps larger properties or a greater number of properties. Oftentimes one achieves that through a 1031 exchange, which is just such an awesome tool that the IRS gives us that I sure have taken advantage of. But some of those timelines with the 1031 can create some stress. So can one do a cash out refinance on income properties, oftentimes that being the form of a second loan, maybe a HELOC? I know the last time you were here, it was still somewhat restrictive on that.
Well, a cash out refinance is certainly applicable. A home equity line of credit or HELOC on investment properties is still elusive. We don't have access to those. We're not currently doing them. But in the 1031 exchange space, because I think what your point is that because the timelines are rather restrictive in identification, and then the markets themselves, the sellers want to move quickly. So in the instance where maybe they paid cash and they met the exchange requirements, can they turn around and just do a cash out refinance under a 30-year fixed mortgage? Absolutely. Those terms are very agreeable right now, 75% loan to value, and even as high as off the ARV. As an example, if they bought the property maybe a little distressed or undervalued, they can turn around and refinance it using the higher after repair or after market value on the appraisal.
So just to clarify, you're talking about up to 75% loan to value if you just go in and refinance the entire mortgage on that income property.
That is correct. Now that applies to single family residents only. If the property were a 2, 3, or 4 unit property, then it would be 70% loan to value.
That is great information. Now, sometimes other lenders out there that don't do so many income property loans, they run into problems with seasoning requirements from turnkey providers. Can you talk to us about seasoning requirements?
So this gets a little bit trickier. When we're talking about cash out refinances for investment properties, there are 2 staples from a conventional guideline perspective. The first is the delayed refi, that's the name of it. The second is the standard cash out refi. The primary difference between the two is going to be speed. The delayed refi does not have any seasoning requirement, but it has some restrictions. I'll go over those briefly. And the standard cash out refi has a 6-month ownership seasoning requirement before we can go 75% ARV. The delayed refi requires an all-cash acquisition, and the cash back to the individual will be limited to the acquisition costs listed on the final CD, closing disclosure, when they acquire. So if there were costs associated with the investment that they paid for after closing on the purchase that were not listed as part of the acquisition cost on that closing disclosure, they would not be entitled to those funds on the cash out refi. Whatever they're going to get back has to be listed on that CD on the delayed refi. No seasoning requirement, all cash acquisition is necessary.
Now, I'm really glad that you explained that. I actually did not think of asking about that. What I was asking about was when an investor goes in and makes a new purchase from a turnkey provider, say that turnkey provider had only held onto that property for 3 months from the time that they took it out of distress and rehabilitated it and sold it to the investor. And that period was only 3 months. That gives some lenders pause because they want that seasoning period to be longer. But you don't have quite that same restriction there at Ridge. Tell us about that.
I'm sorry. Yes, of course. I misunderstood the question, Keith. But yeah, you are absolutely right. We don't have that restriction. The only restriction we're going to find is that the seller must be recorded owners, right? It has to have actually gone through the county and show recorded ownership before they can enter into the contract with the buyer or our borrower. So just in other words, let's say the county's a little bit backed up and the seller acquires the property on day 1 and they sign a contract. They paid for it. They believe it's theirs. They've signed a contract with their buyer and for a 30-day close, but the recorded ownership doesn't take place for another 10 days afterwards. That's when I will have a problem. I cannot take a contract written from a seller to a buyer until the seller has a official recorded ownership. And they'll know, the turnkeys know what that is. And I find that very rarely anymore. It used to come up a lot more in the past, but that's not an issue anymore. But otherwise, the 3 months of ownership, no issues at all for us.
Okay. So oftentimes, especially a brand new investor that may have never purchased income property before, they might be trying to do what they need to do to rearrange their financial life so that they can qualify for a property. Maybe that isn't until a few months down the road. What's something that a new investor can do in order to position themselves to give them the best opportunity to qualify for a loan? Because you're typically looking at the previous 2 years' tax returns in underwriting. So tell us about that.
That's right. I would say that legitimately their best next step would be to go through our gauntlet of pre-qual so that we can advise them appropriately. If they think they're not quite ready, I don't think that it's necessary for them to wait until. I think it would behoove them to get the pre-qual process started immediately so that we can help them determine what steps need to be taken to get the pre-qual or get the qualification pieces in line. Now, we find ourselves in a unique place in time. having closed out 2018. Most people have not yet filed their 2018 tax returns, which is wonderful for our purposes. If someone is thinking that their qualifications may just miss the mark, pre-qualing right now will give us an opportunity before 18 is filed. It'll give us an opportunity to identify how we might use the 2018 tax returns as a platform to advise them how they may want to file from a Schedule E perspective, a Schedule C perspective if they're self-employed. Once the return is filed, it's filed. We would take 17 and 18 at that point. But again, and maybe I'm not being as clear here, as it starts, we would take 16 and 17 right now if 2018 was not filed. But providing us with a draft of 2018 gives us an opportunity to advise our clients appropriately to say, okay, here's what you would need to do in order to optimize your qualifications once 2018 is filed and for the remainder of the 19 year.
That is a great route. So basically, you're asking that prospective borrower to be proactive. You're not bugging Ridge, and that way Ridge can tell you what you need to change, how you need to position yourself to give you the best chance to qualify for a loan. We're talking about a really dynamic field here. So with the Fed's revised outlook for fewer rate hikes this year and going ahead than they had projected previously, that creates some changes in movements in the bond market. So tell us about that impact that it's had on rates, and it's actually brought rates down somewhat from where they were late last year.
Can you believe it? So this is interesting to me, and I'm not smart enough to try and predict how the secondary markets and all the algorithms associated with the long-term interest rates are going to play out, overseas issues and the GDP, all of that stuff plays a role. But it was widely predicted that interest rates were going to continue to go up on a very steady trajectory
for
the remainder of 2018 and all the way through 19 and beyond. I have some theories that I'll probably keep to myself. I don't want to get too political, but as a result, interest rates are down, much to everybody's pleasant surprise. Middle of December last year, we were probably 6.25. And as I disclosed earlier in our conversation or in our discussions, we're at 5.5 and 5 1/8, depending on the down payment. So that's a huge drop in interest rates that I don't think anybody expected to see. So we're happy. Our investors are happy. They get to take advantage a little bit longer of those low rates. But you and I agree, that's not the big picture differential on real estate investing, but we're going to take advantage of it.
Has that increased your volume in there at Ridge?
I'm not sure if that's the defining factor. We are up actually 30% in volume from this time last year. So maybe that has something to do with it. I'm not sure. Most investors, I would say, don't keep as close an eye on the interest rates when we start the game. I think that the returns in the markets are still producing very well, and more people are finding that real estate is a very solid means of long-term financial security.
Yeah, maybe those rate hikes from last year helped to knock some people out of complacency, and that rates really are not going to defy gravity forever and stay low. But who knows? I'm speculating now. Tell us about an advantage of using a company like Ridge Lending Group versus other lenders, because in there you specifically focus on non-owner occupied income property loans for the production of cash flow.
And it really is a different animal. Anybody that's been through the gauntlet of a loan process, a conventional loan process, knows that not all lenders are created equal. I think I've identified a few of those reasons in the call here. But overall, I think that Ridge Lending sets itself apart based on experience. Education is a big part of our focus. Attention to detail, certainly customer service, accessibility. We're very good at what we do, and I think it just comes through in our overall process and the attention that we give to our clients.
Well, you've helped more of our listeners than anyone else. And at last check, you offer loans in 35 to 40 states, especially those ones that I call Investor Advantage in the Midwest and South.
I think we're up to 43 states now, Keith. I'm just updating, coincidentally, the math on our website should be updated in the next week or so with the newest states that we secured.
Terrific. Well, if someone wants to get started, what's the best way for them to do that?
There's a few ways, actually. They can go to our website, which is www.ridgelendinggroup.com. They can email us at info@ridgelendinggroup.com, or they can call us toll free at 855-747-4343, 74 Ridge is an easy way to remember.
Caeli Ridge, I learn a little something new each time I have you on. Thanks so much for coming back onto the show.
My pleasure. Thanks for having me, Keith.
Now, if you've been paying attention to our mortgage updates here since 2014, 2015, you'll notice that it's somewhat easier to qualify for income property loans now than it was a few years ago. One such place is the reserve requirements that are needed. You might also remember, maybe it was a year ago or so, that the way many agencies calculate credit scores has boosted the average score by just a few points. But yet, it's not too easy. It's not too easy to qualify. We're not in those ninja loan days that all came to an abrupt end about 12 years ago. What's ninja? That's an acronym for no income, no job, or assets, because in 2005, you virtually did not need an income or a job or assets, and you could still get a big loan. Back then, a $40,000 a year wage earner could have gotten, say, an $800,000 loan or more with a low down payment. And it's a good thing that we're not there anymore. Back then, borrowers defaulted when they couldn't make the payments after a while. And they all thought they were going to be able to make the payments forever based on refinancing the property at a higher amount and then pulling all the cash out each time. Well, we all knew what happened, and the housing market soon couldn't support itself. That same phenomena can't happen today. Today, you still need to supply full documentation to your mortgage underwriter when you're qualifying. In a sense, that's good because you don't want it to be too easy to qualify. And I'm going to tell you more about why. I remember back in 2005, now this was a time where I owned small apartment buildings, and even though the economy was strong, I soon found myself having trouble retaining tenants in my buildings. Yeah, my tenants left because it was too easy for them to qualify to go out and get their own starter home in 2005. So you don't want it to be too easy to qualify. Now, there are plenty of pros and cons with apartment building investing versus smaller properties. But if you own apartment buildings and as the pendulum keeps swinging away from stringent loan qualifications and toward more loose ones, your apartment tenants might leave. And that's because many apartment tenants would prefer the privacy of living in a single-family home. So instead, if you're already renting single-family homes to tenants, they won't move out so fast, even if mortgage underwriting standards became loose again because they've already got the privacy of a single-family home. If you believe Jim Rogers and that rates are going to go higher over the long term, well, that also tilts away from apartments and towards smaller 1 to 4 unit properties because with smaller properties, it's easier to tie up long-term 30-year fixed rates than it is with larger apartment buildings. You might have to refi your apartment loan in 8 years. What do you think rates are going to be then? You don't run that risk with 1 to 4 unit properties. In some cases, it is absolutely impossible to get 30-year financing. Actually, it's interesting. My journey as a real estate investor so far has been that I began with apartment buildings, and now I'm loading up on single-family homes for some of those reasons I just described. Well, that's exactly backwards from some people's real estate investing journey. I began with larger properties and have since migrated towards smaller ones. I think that some of the best news from Caeli Ridge today is that the loan terms beyond your first 10 loans for single, 20 for married, just continue to become more favorable than they were in the past. Well, if you want to act, what do you actually do? Well, let me give you some highly actionable material. Work toward getting pre-qualified with a lender. We just talked with a good one. Around the same time, see what property provider interests you at greturnkey.com. That's the website that shows a list of where I go to buy my own properties as well, in fact. Get a hold of a free investor report at greturnkey.com and connect with the provider there. Now, terms among providers are somewhat different, but in general, what you do is that you can get an income property reserved with a contract and place a refundable deposit while the renovations to the property are still ongoing. Then this gives you, the buyer, ample time for your third-party property inspection, which I always suggest, and that often costs you $400 or less, and have your lender initiate your appraisal and any other due diligence work that needs to be finished. That might include your management agreement and your landlord's insurance policy. Now, while you've been doing this, as the property renovations get completed, that's when you have your right to have your chosen home inspector visit the property, and there will always be some inspection findings. Maybe the inspector found that the doorbell didn't work. Maybe there's condensation or moisture between two window panes. It seems like having your ground fault circuit interrupters functional and in place is one of the most common inspection findings. It will all be in your report that you basically bought from the inspector. I've got to tell you, all the home inspectors I've worked with in the last year have been really good at getting the reports turned around and emailed to me promptly. Well, then next you have to ask the turnkey provider to remedy any of those inspection findings that were in the inspector's report. And at a minimum, you should ask to have the health and safety related findings accomplished. Then it's up to you whether you want to have a re-inspection done to make sure that your turnkey provider did indeed fix what they said that they were going to fix. I almost always have re-inspections done. That's often under $100. Then your appraisal hopefully comes in on value. An appraisal is a tool that your lender uses to ensure the quality of their collateral, because in their eyes, your rental property is the bank's collateral. Then with your approval from whoever you choose to use as a lender, most Get Rich Education listeners use Ridge Lending Group, but whomever you choose, that lender makes sure that the closing funds are sent to the title company and you are signing your closing documents. Most of the time, you're buying in an area where you don't live, so a mobile notary will come to your house or your workplace or wherever, and you do the closing there. So yes, for the largely passive real estate investor, the most engaged you'll typically be is at transaction time, and you'll just get quite a few emails floating around. And in your Gmail or wherever, just designate a folder that you'll name Houston Turnkeys or Chicago Turnkeys or Tampa Turnkeys or whatever. Then make sure your provider gives you good post-renovation photos of your property. It's a good idea to save them to a cloud-based storage service. I use Dropbox. Check out the resources mentioned part of the show notes today if you couldn't remember those websites. The first two links under resources mentioned are the ones that I just mentioned. They're the most actionable resources in helping you get started. Thanks to Caeli Ridge today. She's been super helpful. In fact, you might remember where on a previous episode here, I was looking over a settlement statement during the interview, and she told us where every one of the charges that appear on your closing papers actually comes from, line by line. So some good transparency with Ridge. Next week, it's the month of March. That means we're kicking off Rich Dad Month, with whom is also the most recurrent guest in Get Rich Education history. Tom Wheelwright will be here to tell you how to crush your tax obligations down close to zero. Then we have a different Rich Dad advisor here every week until the last Monday in March, when Robert Kiyosaki and I tell you about the importance of investing in real assets. Big thanks to the terrific Caeli Ridge today. Tell her good people that you really appreciate them. If you do decide to get your next income property loan, start at ridgelendinggroup.com. Rich Dad Month kicks off next week. I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Countless investors get killed on their long-term maintenance costs in their rental property portfolio, but that's far less likely when you buy brand new construction. Let me tell you about my friends at JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model that allows clients like you to invest in new construction, turnkey rental property. That's why JWB has been featured on the front page of the Wall Street Journal and other national media. If you want new construction rental properties in your portfolio, talk to JWB. Give them a call at 904-677-6777 or visit them at newconstructionturnkey.com. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.